Good morning, good evening, good afternoon. Whenever you are watching this week's video, we're going to finish out our series, y'all. Why are we going to finish out our series? Because I told y'all we would. Y'all see, I done been resting. I done been eating snacks. I done been eating lunch. I done been drinking my water. My color is popping. Yes, to my loctician. Go natural centric. Go natural centric. We in the building. For those who are on social media, you see that Patrice L. Berry EA is now a registered trademark. We got some other trademarks coming through. Life is good. Life is good. We are now week 2 past the extension deadline, right? We are actively working on things and getting things together, looking at working through our extension piles, working through prior tax returns as we come every day, chugging along, not breaking our neck to do it, but keeping a steady pace so that we stay within our core hours, right? So I'm not saying that we don't find that everybody is not valuable, but because everybody is, but we are sticking very true to our core hours of working from 8 to 5, and then as I told some of you all, I stay on around like 5:30, but after like no longer than 6 o'clock, I'm off the clock. And sticking true to myself, this is the first past weekend that I actually looked at the office and kept it moving. Like I might have stepped in for a second, but I said, girl, no, give yourself some grace, give yourself some reset so that your brain can handle it. So now let's walk in, right? Because my team has done a great job of helping us create some things for teaching points so I can break this thing down. I said I was going to go through the worksheet, but we're going to do it in a different manner. It's going to be very much me teaching more so like I would do a mini webinar. We're going to get it in, give examples at each of the different filing statuses, right? So single, head of household, married, filing jointly. The reason why I didn't do something for married filing separately is because married filing separately files like a single person, right? So their rates and stuff like that are very similar. So we're going to break this down and we're going to use numbers, round numbers, so that we can illustrate, right, when we're talking about why everything is done this way. So have you ever really wondered why some investment taxes like qualified dividends and capital gains long term get taxed at different tax rates, and what this actually would look like and how that would work when you make more money? Well, we're going to talk about that. Remember, the key range for us in this is 0%, 15%, 20%. Those are what we use for our long-term capital gains and our qualified dividends rates. And you want to know how that thing is split up. And if you've never looked at, like last week, I went through a crazy blank worksheet. God bless me, y'all. I went through a crazy blank worksheet. God bless me, y'all. And this week, we're going to do the same thing, right? So qualified dividends get reported. And I always say this, if you ever listen to one of my recordings when I'm looking at your tax return, qualified dividends are on the left side, ordinary dividends on the right side in the line, right? And then long-term capital gains get mixed up because we just quote, when we do capital gains, we do a total number, but when we break it out, when we go back into our worksheets, you'll see the breakout for short-term capital gains versus long-term capital gains, and they are actually calculated different in behind the scenes. So we're going to take our time. We're going to make sure that we go through this lesson. I'm not going to watch y'all. I'm not going to have y'all watch my computer spinning and it be dark and me screaming like, hey, because even with the update that just got pushed, I don't know if that's going to change. So the next thing you're going to see is the charts. You're going to hear me. I am going to do a presentation for you all, get down and dirty, and then I'll come back and then we'll talk about it and wrap it up. All right. Sounds good. Wonderful. Let's get to it. All right. Everything works seamless. Of course, the reason why everything works seamless is because y'all know what it is. Y'all know what it is. All right, so understanding qualified dividends and capital gains. We're going to use the real life scenarios for single members, married, filing joint, and head of household. Produced by Nutty. Y'all see that? Y'all see that? Let's go. Let's go. Let's go. All right, quick and dirty. All right. Why making sure you understand everything matters? Why? Because it does matter. We've talked about this over and over and over again. We got long-term capital gains can be taxed at 0%, 15%, or 20%, right? It's talking about dividends, but that's really qualified dividends. We got to be specific. It's not ordinary dividends, right? Or qualified dividends and long-term capital gains can be taxed at these other rates. That's part of the sweet sauce of the tax code. Your filing status affects how much income gets lower taxes, gets the rates. Why? Because there's thresholds, right? And everybody's standard deduction is different. The amount of tax based on your filing status makes a difference. I don't make the rules. That's what Congress do, okay? This is going to help you with tax planning. So now when you're strategically trying to figure out, if I'm cashing in, right? If I'm actually cashing in my stocks, well, do I want to be taking care of something that, am I going to continue to be day trading, or do I want to look at something that I've been holding for a longer period of time because it's tax advantages for me filing it in a different, pulling from the older ones. That's the best way to try to describe it. All right, let's go into our single scenario. All right, let's say the person has $50,000 in wages and $4,000 in qualified dividends and then $6,000 in long-term capital gains. All right, their standard deduction for the filing season that just ended and that we're in extension season 4 is $14,600. That's just the standard deduction. That does not mean that they can't itemize. We just throwing these numbers out here. Let's go on and look through this and see what happens. All right, so y'all see this? All right, so if we're looking at this, we got, right, 50,000 plus 4,000 plus 6, and this is just high numbers, right? 6,000. So we talking about 60,000 minus $14,600 because that is our standard deduction. We talking about 45,400 in income, right? We trying to get there, right? Let's say that's our taxable income, right? My KANG for all of you who listen to my videos. Qualified dividends is 4,000. Long-term capital gains is 6,000. We're going to add these two together because that's our, how much additional income do we have that's got preferential treatment, meaning that it's going to be taxed either at 0%, 15%, or 20%. So that's $10,000 of that income. Now we got to subtract that. This is the worksheet we were going through before. We're going to subtract that from our taxable income. That leaves us with $35,400 of ordinary income versus $10,000 as preferential income. All right. So we got to find our capital gains cutoff. So remember we was looking at that worksheet and I was like, hey, filing status matters. Thresholds matter. My queen doing her thing matter, right? So we looking at that. Single capital gains cutoff at 0%, right? If you've made $47,025, if you made more than that, then you're not going to qualify for 0% tax on that. So now we're going to subtract line 5 from line 7. How much room we got left for the 0%? We got $11,625 left. We're going to enter the smaller because, of course, you got to do the calculations and do these worksheets. We're going to enter the smaller, line 4 or line 8. Well, $10,000 is smaller than this. How much tax we going to pay on this? So we're not going to be paying tax on that $10,000 or these qualified. We're not paying tax on that, right? How much total taxes due? We're going to add line 6 and line 10. No taxes due on these capital gains and qualified dividends. But y'all got to remember, we still got ordinary income that's got to be taxed. All right? Let me know if that makes sense. Now, let's take a similar scenario, okay? If you're married, filing joint, and your wages are $90,000, and you got qualified dividends of $8,000, long-term capital gains of $12,000, your standard deduction is different. Y'all notice this, right? It's almost double, right? It's exactly double of what we got for single. This is why you can use the same scenario for single that you do for married, filing separately. All right? So that's our standard deduction, $29,200 for 2024. Let's go through the same scenario. All right. In this scenario, we got 90,000 plus 8,000 plus 12,000. That's so additional 20,000, right? Equals 110,000. But then our standard deduction, we're going to take it. Let's say they just get the standard deduction. That brings our taxable income down to $80,800. But we got $20,000 in dividends and capital gains that have preferential treatment, right? How much does that leave us for ordinary income? $60,800. Well, the limitation on this for a married filing joint is we got up to 0% if your amounts are making $94,050. Well, how much we got left in here? Remember, we got ordinary income. Subtracting from this amount, there's $33,250 on the table. Which one's smaller? My $20,000 that I got going on here. Well, how much tax am I going to pay on this $20,000? None. You're like, what? I just got some money I don't have to pay tax on? Yes, that's the beauty behind this. All right, now we got head of household. That person makes $70,000. We got $2,000 in qualified dividends, $3,000 in long-term capital gains, and their standard deduction is a little bit higher than the single person, well, significantly higher, but lower than head of household. I mean, the married filing joint. It's $21,900. I'll make these rules. Y'all got to go talk to Congress. All right, so we got $75,000 for our income before we get to the standard deduction. $70,000 plus $2,000 plus $3,000, that's $75,000 minus our head of household standard deduction. That leaves us with taxable income of $53,100. We have preferential income that we earn, $5,000. We're going to subtract that. And so our ordinary income that's left is $48,100. We're going to do our calculation. Now, head of household's income, when it comes to that range of 0% for capital gains, $63,000. So now we got to figure out what the difference is, right? We got some wiggle room here. $14,900. Are we good? Are we in that range? We certainly are with those $5,000 in qualified dividends and long-term capital gains. We are. So how much tax are we paying on this? We paying zero tax on that $5,000. Zero. Okay? So now you get an idea, and I didn't take you through each one of the ranges, right? But I want you, qualified dividends and long-term capital gains can lower your tax bill. Y'all can see how that can be the case. Each filing status affects how much of your income qualifies for lower tax rates. Always apply the standard deduction before starting tax rate calculations. These are things to remember. The biggest thing I want you to remember, y'all, so y'all can see my face in this. Hold on. Oops. Let me get up here so you can see me. The biggest thing I want you to remember is that this is what we're talking about of the weight of passive income. Passive income is actually being taxed differently. In these scenarios, y'all can see qualified dividends, long-term capital gains, that's passive income. And they have different rates that they're being taxed. We just watched in each one of those scenarios, 5,000, 20,000, etc., not have any taxes on it. Now, that don't mean that all your money don't get taxed. It's just being taxed at different rates based on the style of income it is, your filing status, all of this stuff matters. Now, I could have taken you through and said, okay, well, what's going to happen if it's a 15% range and a 20% range? But instead, what we're going to do is we're going to actually make sure that you can see that those ranges at the bottom. So you can understand, okay, well, when does it phase out for me? How do I know if I fall into the 15% category? How do I find out if my passive income is being taxed at 20%? We're going to make sure that you get those tables so you can at least see what they look like for 2024 and kind of gauge yourself around that pivot point as you're planning out 2025. I want you to be strategic if you can be, right? Because it's sometimes where I'm out here doing swings in their short-term capital gains, so it's being taxed at ordinary rates as well. But I want you to be strategic in what we're doing, right? And if you're day trading, understand you're going to get hit. That's your ordinary income. That's your profession, right? But if you're holding on to things a year and a day when it comes to stocks, and if you're looking and making sure that you qualify because you got some things that are dividends and we want to hold it for that 60-day period to make sure that we're good to go so that we make sure that we get them qualified dividends, I want you to at least be aware and strategic behind the reasoning why you're doing what you're doing. Because then you can say, okay, I feel like I'm a little bit more in control of this. Now y'all probably have an idea of like, oh, wow, this is why Patrice is geeking out and being like, ooh, it would be interesting to have dividends like $5,000 a month, because that'll give me like $60,000 in passive income. That now you got to buy a lot of shares. Yes, I understand, but the concept of having $60,000 in passive income that could qualify as qualified dividends instead of ordinary income is amazing to me. And so I'm strategically looking at ways for my own self as to, ooh, let me leverage the code so that I am making better decisions as to what I'm doing in my portfolios, as to how passive income is coming my way, so that I can take advantage of the tax code. And I definitely think that that is something that you should consider as well too. Just take the time to really be looking at your brokerage statements, or thinking about, let me see how long I've held this company before I sell it, so that I understand it and making informed decisions instead of emotional decisions. Now, if your back is against the wall and you got to pay some bills, and you lost your job or something like that, I get it. Sometimes you got to do stuff differently. But tax planning does come in handy when you at least can know what your trigger point is going to be. Worst case scenario, these if this then that type thing. And I think right now in this season is a great time to like pause, take inventory, and start to develop your if this then that scenarios around what is happening, and be aware of what's happening in your portfolio too, and how it is going to be impacted by the tax code if you have to trigger and execute one of your if this then that scenarios. I would like to also challenge you, because I'm going to do this as I'm talking out loud to myself. Actually write down my if this then that scenarios, because then when the situation happens, I can remember and the promise I made to myself that, hey, we already planned this out and said, if this happens, then that. Very similar to when I took a loan against my life insurance policy, or loans that I've taken against when I was in the federal government against TSP, and how I was going to pay them back, where I came up with a strategic plan before I ever executed and took the loan, and have been actively sticking to that plan because I knew what it was for. I knew what I was going to use the loan money for. I knew how I was going to pay it back. I made that promise to myself to stick to that plan to pay it back. This is the same thing we need to be doing in this case. And I hope this triggers even more conversation, or wraps this up in a different manner, so that you as well will go forward and ask yourself, or ask yours truly, or even send me a question to being like, well, Patrice, could you break this down a little bit more? Or could you do a better explanation about this topic? Next week, we'll have our May, right? Because April showers done brought May flowers. We will have our May monthly newsletter. And then after that, if there's a topic you want to talk about, let me know. Or else I'm going to get in my bag and go ahead and do what we need to do, so that we can make it crack-a-lack-a-lack on that 529 trust and break things down further. Until next week, I try to keep this as close as possible. I knew I was going to be teaching a lesson with slides. I hope this makes sense. I hope seeing the numbers and seeing yourself in one of these slides made a difference for you. Until next week, I'm going to holler at you. Peace.